Oke, Assalamualaikum warahmatullahi wabarakatuh. Terima kasih, nama saya, Arif Kusuma. Saya Country Director Aptivaa Indonesia. Mungkin sebagai pembukaan, saya akan membawakan dalam bahasa Indonesia, karena nanti waktunya juga 45 presentasi dan 15 Q&A. Kalau memang masih ada pertanyaan, bisa di Q&A button di situ, atau langsung nanti WA ke saya, karena nanti rencananya memang Pak Nasir akan juga roadshow di Indonesia. Nah, jadi hari ini mungkin lebih ke waktu beliau sangat sibuk. Jadi saya coba kasih profil sedikit mengenai Ahmad Nasir ini. Jadi beliau warga negara dari Inggris ya, kebetulan ancestor-nya dari Pakistan. Nah, beliau sendiri, Pak Nasir ini ahli climate risk. Jadi kalau Bapak-Bapak dan Ibu sekalian ketahui, climate risk adalah salah satu hot topic yang dibahas di regulator, perbankan, dan tanggal 15 April kemarin kita sempat bahas juga dalam seminar yang sifatnya offline dan online. Nah, beliau sendiri kalau bicara risk management, rasanya beliau sudah lebih dari 25 tahun plus, mungkin 30 tahun lebih. Dia sendiri juga berasal dari Big Four Consulting, S1-nya di UK, S2-nya di fisik ya, dan S3-nya di bidang matematik di Swiss Federal Institute Technology in Lausanne. Mungkin saya nggak akan berpanjang lebar, bagaimana nanti Pak Nasir akan membeberkan secara detail, karena dalam risk management itu ada risk modeler, ada stress testing, dan analisis termasuk prediktifnya. Dan bagaimana climate risk ini bisa mempengaruhi kalau di perbankan itu termasuk NPL-nya, profitability, kenaikan 1-2 derajat itu juga seperti apa. Nah, jadi ini sangat menarik sekali topik yang akan dibawakan. Tolong kalau ada apa-apa di chat, dan sisanya mungkin kita bisa follow up secara offline. Oke, over to you, Nasir.
Segitunya ya.
Arif, thank you.
Yeah.
Guys, hello.
Yeah, we can hear you.
Okay, you can hear. Very nice to meet everyone. So let's just start with our seminar. I'm just going to share here. So I can't share actually my screen. Can you allow me to share, please? Arif, Pratik, okay, thank you. Now I can share. Can you guys see my screen?
Yes, we can.
Okay, great. Okay, so let's start. So, I mean, the goal is, as per the announcement and so on, we'll talk about climate change, we'll talk about climate risk management, impact risk opportunities, regulatory requirements. The OJK has written a lot on it. Risk management, including scenario analysis, which is the main topic, and stress testing, which is sort of very connected to scenario analysis, the data, models, technology, climate disclosures, and so on. And one thing very important is that we sort of try to give practical examples of actually having done several engagements in projects with many different institutions in this area. What are the common challenges? How can you mitigate those challenges, and the best practices and industry insights? So that's sort of the content as you were expecting. Maybe just as an introduction, it's worth mentioning that sorry, I'm just going to move this thing here. Our experience in climate risk and scenario analysis, it covers tier 1 and other financial institutions, including tier 1 banks in the UK, EU, US, Canada, Australia, UAE, also lots of other GCC countries now starting engagements like Jordan. Different jurisdictions and regulations. We've done work with the Bank of England or related to the Bank of England, their templates, their requirements, European Central Bank, US Fed, Central Bank of the UAE, etc. And we work closely with several climate data providers from large firms to small sort of firms, including Morningstar, Sustainalytics, which is sort of together, Bloomberg, and etc. So that's sort of our background. And the above experience has allowed us to extract common approaches and methodologies across climate scenario analysis and stress testing. And you may be wondering, what is it? So the use cases, what do we mean by use cases here? There is climate stress testing, like, for example, required by different regulators, including OJK. There is the climate risk and ICAP, which is your internal risk management. And now climate risk is an important risk factor. So you have to do that in ICAP, which is different from from what you do for the regulator. Yes, from far, it's very similar, but in details, it's different. And the way you set it up is different. Then there is scenario analysis as part of sustainability reporting, like CSRD in Europe, TCFD internationally. And I know that TCFD is also sort of very aligned. The OJK is very aligned to TCFD, as we will see. So from that perspective, there are many use cases. You need to do it for regulator, you need to do it internally, you need to do it for reporting, and you may have ad hoc risk management requirements. The board may ask you to do something. So from that perspective, the climate scenario analysis is not just one exercise, it's many exercises. So if you know how to do it in a common way and you can leverage the methodologies and models, that's a good thing. And then you save time and money and so on. So that experience has allowed us to extract the common elements, which we are going to share with you. It has also allowed us to build climate risk models. And then there are models which are pure climate risk, like how much, if there is a lot of rain, by how much does the flood probability increase in some area by postcode? That's a pure climate model. And then there is the downstream enterprise risk model, which is that if the flood probability has increased for some house in a mortgage loan, then what is the impact on probability of default, loss given default, expected credit loss, IFRS 9 stages, etc. That's the enterprise risk model. And then climate stress testing, sustainability reporting. And also it's very important that if you produce a lot of output, which OJK requires, then how you can summarize it into KPIs and dashboards so that you can use it for decision making. When companies, your obligors to whom you give loan, but also to the bank itself, but when you have exposure to climate risk, as good risk managers, you're not just going to sit there, you're going to do something about it. And that doing something about it is a transition plan. You can say, I'm going to reduce my greenhouse gas emissions. We know that Indonesia is very impacted by climate from heat and from flooding. So you can do something about it from the greenhouse gas emissions, and you can do the adaptation plan, which is actually physical protection, and we'll go in more detail from flood and other things. So those plans are like response of the company, whether it's a bank or your client, the corporate. What is that? And that has to be part of the scenario analysis. So just wanted to mention that in the introduction, that these are the type of things that we've done, and sort of that has allowed us to have some sort of a unified approach, which then allows you to do a lot of things with less effort and less money. Okay, so that's sort of the introduction. If we go further, sort of, then just to sort of show, based on our experience, how different regulators compare to each other. One thing very important, one of the most important things maybe in this webinar, is that this is not just about regulation. It's not just to tick boxes and so on and say, okay, the regulator obviously is very important, the compliance and so on, but this is also about the business impact. If you are going to price your loans and you don't take into account climate risk, well, then that's a very serious thing. So many people are now doing it from a business perspective. And many firms, if you want to get a loan from Asian Development Bank or some private equity, etc., these types of things are required. But nonetheless, because regulation is very important, one has to look at that side. So this slide is about regulation, but the comparison. So you can look at the first column. I mean, yeah, when it says here, Bank of England, then it's the European Central Bank and the US Fed, the climate scenario analysis, Central Bank of the UAE, and then OJK. So when you look at it and you compare the time horizons, the time steps, the balance sheet, the management actions, the type of climate stress test that they do, the inputs, the type of scenarios required, the hazards, which is heat wave, flood, that type of thing, the severity, then you can see that actually the one that OJK is doing is quite aligned. There are differences. Some differences are minor, but it's quite aligned to what other people are doing, other regulators are doing. Maybe the only big difference is that OJK has given a lot of guidelines. So depending on how you count those, there's lots of pages. Just for amusement, we put the last line as the number of pages that people have given as guidance. I mean, the guidance keeps changing and there's more and more guidance, but OJK is the top in the amount of pages written. So in that way, it's very, very detailed guidance that you have. But the type of scenarios that you would use, the type of time horizons that you would use, and that type of thing is quite aligned to what other regulators are doing. Nonetheless, having looked at it a bit closely, we find that OJK is most aligned maybe with the European Central Bank's sort of approach. Even though the other approach, the Bank of England is also aligned to European Central Bank, or the European Central Bank is aligned to Bank of England because Bank of England was the first one to do it. And we work quite closely on the Bank of England one because I'm London based. But I think the OJK is quite close to the European Central Bank approach. So that's just to show you that the approach is quite internationally aligned, and you can leverage the experience from other jurisdictions. Then climate risk and sustainability framework. One goal of this webinar is also to demystify a bit. It's a new risk, climate risk, and there are different points of view. Some people say, no, it's not. Yes, it's a new risk, but it feeds into credit risk and market risk and counterparty credit risk and liquidity and so on. And that's also a good view. Some people say, no, it's a risk on its own. Anyway, risk interact, market risk has interaction with credit risk and so on. I think it's good to think that climate risk impacts credit risk and market risk and so on. So what is there? Climate risk has to have some sort of a framework, which is a bit aligned to other risk frameworks. So this slide tries to capture that. So there is the strategy and governance of how you're going to manage it. What is your climate risk strategy? You can say, okay, the floods are happening or the emissions are high. I'm not going to do anything about it. It's not a very good strategy, but it's a strategy. So there is the strategy, but then there is the governance, how you are going to govern it. Are you going to have a separate committee for it? You need it. Are you going to appoint someone who is head of climate risk modeling? Are you going to even at a higher level, are you going to appoint someone who's the chief sustainability officer? Many banks are doing it or have done it. So that's all the strategy and governance part of it. And you can say, I want to reduce my emissions or net zero emissions by 2050, whatever is the right sort of thing for you. Or you can say, no, climate change is accelerating. I'm going to do it even faster. So that's the strategy and governance. Then to do any meaningful thing, you need data. And that's a big thing, that where do you get the data? What is the data? How do you, and we are going to talk about it. And then there is the risk and the analytics. There's the risk, there's the physical risk, flooding, heat wave, wildfire, like we saw in California earlier in the year. And then there is the analytics, the modeling part of it. So you need to build models, you may need to change your IFRS 9 models, etc. So that's that part here. And then you have the reporting and disclosures. The reporting is a bit wider. You can include the internal reporting. You need to, in the risk committee, you need to have now different slides on climate risk, because sort of in your ICAP, you need to have it. And then there is the external one, which is the disclosure. So you need to disclose. And we've gone through the templates of OJK. Those templates are also very aligned to what other people are doing. And then to do that efficiently, you need some technology. You need some way, some platform of doing it. And if you don't use technology, well, then you can do it in Excel. It's not very good, and it's not very, the audit trail is not there. The operational risk is high. You may not be very confident in your results and so on. But it can be a starting point. But another thing about technology is that ideally, the climate risk and climate scenario analysis and climate stress testing should be done through the same technology as you do for enterprise stress testing and liquidity stress testing and and so on, because computationally it's very similar. Um, Obviously, the data is different and the interpretation is different and the scenarios are different. So anyway, that's the sort of the framework. And here, what we've tried to show on this slide is the target state, what you want to achieve, what the OJK wants you to achieve, but what you want to achieve, not just from a regulatory, but from your business perspective. And what are the challenges? Sometimes the target state is a challenge. So very quickly go through it. In strategy and governance, you need to have articulation of climate risk strategy, impact of strategy on business model. Are you going to change your risk appetite? Are you going to change your lending criteria? In most cases, in most of the projects that we've done, it happens like that. It's natural. Development of climate risk targets and metrics that net zero in 2040 or 50 and that type of thing. I'm not going to read line by line everything, but you can go through it later. But then there's the data side of it. Which data do you need to collect? Some banks end up collecting too much data, but many times some data which is critical is not available. And depending on if a company is private and you have lent to that company, they may not have enough data. So there are many challenges and so on. But firstly, knowing what data to collect. Secondly, knowing the source from where you can get that data. And third is sort of putting that data in the right buckets inside the bank or inside your energy company or whatever it is. And the fourth step is cleaning the data cleansing, putting it in the right way, sort of completing the data and so on. So those are challenges, the data validation and quality and so on. And how is the data linked to the analytics? That's very important. Then is the risk and the analytics part of it. Which models are you going to build? Is it only for capital, like ICAP, or for IFRS 9? No, everyone wants it for IFRS 9 as well, because there's direct P&L impact. So the IFRS 9 point in time PD model needs to be changed, but so is the separate PD model for the same obligor, which is used to calculate the RWA. So you need to build all these models. But even before building the models, you need to say, what is my exposure to risk? And what is my exposure to transition climate risk? What is my exposure to physical climate risk? And just for everyone, I mean, I know that people are very knowledgeable in this area, especially in Indonesia, but physical climate risk falls into two categories, but just as a reminder for some people, one is like physical risk, like hazards, flooding and heat wave and wildfire and hurricane and that type of thing. So it's physically happening. And then transition risk is the risk to the company because of move to the low carbon economy, whether it's for the company or for the sector or for the government or for the country or for globally. And what does that mean? That means if there's a carbon tax, we know that in Indonesia there was a carbon tax introduced. So the carbon tax, now you have higher expenses. So that's transition risk. So you need to measure those exposures, and then you need to do the reporting. And there are many standards. You need to select the right standards. That's a challenge. And there are many acronyms, and some people call it the alphabet soup. It's like a soup, yeah. So it's the PCAF and the GHG protocol and CSRD and ISSB and TCFD and so on. There are many more. But you need to select the right ones. Then you say, now that I've selected, I'm going to calculate my baseline emissions, and then I'm going to report, and then I'm going to see what is my impact on my business model and on my P&L and balance sheet and so on. And then there is the technology, which I've already mentioned. And then there is also, last but not least, is training and board briefings. You need to bring in the organization. You need to train people. They need to understand what it is for. Is it a tick box exercise? No, it is not. It does impact your P&L. How does it impact? What data needs to be collected? There should be a phased approach. So you need to educate, and you need to educate the board as well, because the board needs to ask the right questions and the board needs to approve the right money for you to do the right things then. So all this is important. So this is sort of a summary of the challenges and the target state, where you would like to be in 18 months time, in 2 years time, etc. I mean, it's a journey, so there is no sort of final destination, but you need to get to the you need to sort of start with low hanging fruit and do the milestones in a good way. So that's a framework of climate risk and sustainability. Sustainability is a bit wider. Some people use the word ESG. We also use it, but it's like synonymous with sustainability. And ESG is environment, social, and governance. It is a bit tricky to use that word, but in the E part, which is environment, there are 5 parts generally. One is climate, one is pollution, one is water and marine resources, one is biodiversity, And the fifth one is circularity and waste management. Why is it classified like this? Well, most people have classified it like this, and we follow that type of thing, especially CSRD, the European regulation. So that's should give you a view of that. And then just to make it real, I mean, all this you need to do a project. It's new, and so you need to undertake a project. So what is typical project approach? You need to look at governance. You need to say which things am I going to change in my policy? Am I going to new policy? Am I going to have a new committee? What is the charter of the committee? How do the charters change for other committees? Strategy we've discussed senior level, C-suite level. You need to agree on the strategy for climate risk. You need to set your targets. Risk management we've already discussed. You need to collect the data, build the models. There's a legal and communication side. People want to avoid greenwashing. If you're not doing a lot, but you're saying you're doing a lot, that's a problem. So the communication has to be right, and you have to, and someone can sue the bank or the company for greenwashing. Maybe in Indonesia, it's not a very big thing, but in some countries, people can sue you if you're doing greenwashing. Which greenwashing means that you are saying that I'm doing a lot for the climate, but you are not doing it. Disclosures, yeah, we've talked about it. You need to select which disclosure are you aligned. Obviously, OJK is the most important in Indonesia, but you may want to align if you have international business to TCFD, for example, ISSB, S1, S2, and so on. And then a typical project would involve report writing and roadmap development. That's sort of the initial part of the project and the beautiful project. So we don't want to. I just wanted to show you, like, from an actual project plan. In this particular case, it started in October 23 and finished in November 24. So sort of 13-month plan. I mean, that's sort of typical. It's for a sort of a medium-sized bank in Europe, but you could have it shorter, or you could do it in a phased approach. But the typical other things come in. There's the governance, there's the strategy, business model, impact on your operating model, which includes training, but also processes, people, technology may change. You may need other systems. Impact on impact, risk, and opportunity. People call it like that, IRO, impact, risk, opportunity. So that's sort of, and scenario analysis part of it, stress testing, embedding ESG risk, including climate risk, into risk management, data management, sustainability reporting, and project management. So that's a typical project. So you see that it's sort of, yeah, and we've done many such projects. So sort of we can tailor it all obviously to the different type of banks and so on. And we do tailor it, but this is sort of gives you a view. So I think just, is there a question or? Okay. So that's a question, yeah, from a participant.
Nasir will take these questions at the end.
Okay, fine. Okay. So then I continue. So this is like a typical project plan, just to give you a flavor of that. It's very real and so on. And the essence of scenario analysis we try to capture on this slide. So there is external environment. You can't control it. There's the macroeconomic changes, interest rates, FX rates, and so on. There's financial elements, which is, yeah, FX is financial. Macroeconomic is like GDP changes, interest rate. Financial is FX rate changes, and so on. Oil price change, etc. So then you have physical climate. Some people are saying, and there is evidence that climate change is accelerating. So a lot more heat in some area, more flooding. I mean, I'm based, as I mentioned, out of the UK. It said that it was the driest May ever on record this year. So there was no rain, and now it's raining outside. But generally, as everyone knows, it rains a lot in the UK, but there's no rain this May. So the physical climate risk, there's transition climate, the carbon price changing and so on, and then other changes which impact government policy impacts. And also the transition climate, if they say, no, you have to do a lot of climate scenario analysis, you need money to do that. So then that would impact. But that's not the main thing here. Here is about carbon pricing and so on. So that's the external environment. And then there's not everything impacts you. So you have to filter the right thing, which is relevance for your company, the risks. But there are not just risks. There's the negative side of risk, which is the positive side, which is the opportunity. So there is opportunity. You can do sort of invest in green tech and that type of thing. You can exit some businesses and start new product lines and so on. Sustainable finance, for one. We are having discussion with large UK banks regarding sustainable finance and how they can increase their sustainable finance portfolio. And then all these risks and opportunities will translate into scenarios. I mean, yes, you can start with NGFS scenarios, and the IPCC scenarios and SSB and all those things, RCP, many scenarios and so on. But those are in some ways high-level scenarios. You need to create your own scenarios. And that's a very big thing in scenario analysis, that you need to create your own scenario. It's not that hard, but you need to put some effort into it. And then you have your scenarios, and then you have your company. And then you need to see, what is my strategy? What is my business model? What is my business activities, products? What is my legal structure? Is it just one company or different legal entities in different countries? And so on. Do I own a real estate legal entity? Then what is my business plan? Not just generally, not related to climate, but then related to climate, what is my transition and adaptation plans? Management and mitigation actions, this transition adaptation. So now you have your company, and then the scenario will act on your company, and then you will use some projections using advanced analytics, and then you will have a holistic view of the company under the new risk. Holistic view will be financial view. You will need to generate statements, financial statements. You would need to do your risk statements. You would need to do your sustainability reports. So there are three things: finance, balance sheet, income statement, cash flow statement. Risk is like risk statements. It could be like core app and so on. But yeah, you're going to have your CET1 ratio and RWAs and so on. How do they impact? ICAP report. And then you have sustainability, which is the new one, which is like TCFD and OJK. And then you will produce these reports. So this is in a nutshell what happens in scenario analysis. You need to see what is happening outside. You need to tailor it to your company and the scenarios. And then you need to model how your company is structured and what you are doing. And then you generate, using models, your reports and analyses, and they are by scenario. And it's written here by scenario and by time horizon. You can choose 30 years. For example, Bank of England requires 30 years. ECB requires, for some scenario analysis, 1 year horizon, for some 30 years, and so on, for some 3 years. So this is a summary of scenario analysis and how it works. Most of it, yeah. I mean, obviously, we'll go into details now. But just to say, how does it sort of, what's the end result? So this is with this red thing here. This is an actual Bank of England template, and that requires banking retail projections, some template. And it says, yeah, the key things, there are the many templates, there are many things to be done, reported, but there's just an example. And it says proportion of drawn balance on properties damaged due to physical hazards at the end of the projection period. So here it goes to 30 years. And then you have three scenarios: early action, late action, and then another one. So yeah, here they're just shown here. And then you have proportion of properties damaged due to physical events at the end of the projection period. So this is the type of thing, that how many properties get damaged. This is an example. This is the output. Once you've set up everything, you will produce reports like that. This is from the European Central Bank, an output, just to make it real for you. So here it's again the sort of same thing, but here you see this TR321, what is it? It's IFRS 9 stage migration. So how much stage migration takes place in this particular example? Not that much, but yeah, you can have a lot because of climate change. And this is sort of, this is an important part, that if climate change can make obligors move from stage 1 to stage 2 and from stage 2 to stage 3. And that is what the European Central Bank wants to know, and OJK as well. Excuse me. And then this is another example, yet another example with the same. And all these colors are from those institutions, from European Central Bank and Bank of England. And this one is also the original template from the Central Bank of the UAE, where we were working to support some banks on their climate stress testing, both physical and transition. And then, as you see, that it's very important to get loss given default, calibration rating, etc., and sort of so on. Calibration, PD, this is how they call it, with the change in climate. How do your PDs change for different sectors, construction and real estate and different things. So this is the output. So once you set up everything, this is what you are going to get. And the OJK templates are not too different from these three. Another thing that you may want to get, which TCFD requires, is that for your bank or for your clients, you may need to produce financial statements. And here we said that financial statements, sorry, are a very big part of it. So finance here, financial statement, balance sheet, income statement, cash flow statement. So you may want, for each scenario, you may want to produce your own balance sheet, own income statement, own cash flow statement, and also for your large obligors to whom you've given loans. And then you would have something like this column here. The first one would be the line items. If it's your bank, it would be your bank's line item. Otherwise, it would be your obligor. The gray part are the historical values. For this one, we assume that we are on 1st January 2024. So then you have, and then the green ones are the projections. So for each scenario will have its projection. So you will have projections for for each scenario of balance sheet, income statement, cash flows. But these are not the only statements. You can have statements on your greenhouse gas emissions. This is taken from the European regulation, but other things can be like that as well. I mean, we know that CSRD has been rolled back a bit, but that was the original CSRD. Basically, what it says, how your scope 1, 2, 3 emissions are going down. And as we know, scope 1 are the main emissions from if you're a factory producing, and scope 2 is related to your energy use essentially, and scope 3 is your upstream and downstream, which is the hardest to calculate. And for a bank, that's the biggest one. But all these emissions combined is your total carbon footprint, and how is it going to go down? Because if you are going to contribute to climate change, then you need to reduce your emissions. But it's not just about contributing to the environment or ticking a box for the regulator, it's about your P&L as well. So there are three sort of drivers. The main driver could be your P&L, the second driver could be the regulation requirement, and the third is contributing to the planet. So there is lots of this type of thing also you can come up with. You can say this is just an example of the Philippines, but you can have for Indonesia, and we have lots of things for Netherlands, UK, US, Denmark, and so on. But it shows like this is produced from Morningstar, who we work closely with. But this is like you see fire, flood, landslide, stat is combined, and how the climate score, which is a combination of this, how it is evolving over time in different regions and so on. This is about physical climate risk, physical risk here. And then you can have the tail, loss, damage, and so on. All this will come out of your analysis. But this is just to show that you can have lots of good analysis, which will allow you better decision making. And that's the whole point. So you can have portfolio level analysis, or you can have asset level analysis. Okay, that's sort of the output to give you a flavor of the output. There's also that thing that you can have, for example, people call geolocation, longitude, latitude. So you can have, for example, if there's a company that has stores in different locations, and these are the different locations across the globe, and then the circle means that whether if it's red, closer to red, then it means it's a lot of climate risk, and if it's green, it is not that much. And the size of the circle means that how much it's contributing to revenue. So you can have this type of thing, and you can move the red stores if you can. I mean, sometimes you may not be able to, and then you can do that. That's your adaptation action. And then you can have graphs like this for decision making, which says profit for the year. How does it change if I don't do anything? Without adaptation actions, that's the red line, and with adaptation actions. And adaptation actions will cost money, so the profit will go down, as we see here, but it can then go up. It doesn't have to, but in this scenario, there's an actual scenario, an actual project that we did. The profit did go up in later years, 2032 or 2032, yeah, around that. But here it goes down because you need to invest money to build sort of climate. So I think that just gives the view, and this is from a physical risk because there are these stores and you need to move them, and it's flood risk. But this is an example from transition risk. So for the left-hand side is taken for TCFD, it's just copied from it, which says that this is your history here on the left-hand side, the white part. And then how fast are you going to reduce your emissions? So there are 1, 2, 3, 4, 5 parts. And this is part of your strategy. How fast are you want to reduce it? And obviously there are detailed templates of OJK that talk about GHG emissions. And then for each one, you need some CapEx and OpEx, the money to do that thing. And then you can calculate for your own bank, your own company, or for your clients. If you're a bank, if you can give them the CapEx, that's a very big thing for sustainable finance, that you provide the money so that the company can transition, and then you earn the interest. So that's a good thing, and that's part of the sustainable finance portfolio. And we are helping several large UK banks in doing that. Okay, then this you know very well. I'm not going to go too much into detail, but this is taken from the OJK document. It's actually a very good chart, and it explains how you have transition risk factors, which we've covered, the physical risk, and then impact on the economy and the company, the obligors that you have, and then the impact, which is sort of, it was one diagram, but it was divided into two, and then the impact on your balance sheet and income statement and cash flow statement. So actually, and then finally on your capital ratios. And actually, so this actually what this framework says is that you need to calculate the impact on yourself, on your income, balance sheet, income statement, and cash flow. This is exactly what you need to calculate. There's more than that that you need to calculate, but here it talks about income statement, balance sheet, cash flow statement. Here it's just copied from the OJK. And there is other, this is sort of CapEx, OpEx. So this is exactly the type of thing that you want from here. And this, I just show that we did some analysis. Aptivaa did some work in sort of in the UAE on the average PD evolution by sector. We did at the obligor level, so it was very granular, but then we aggregated it and we have so high impact sector is the orange one, and then medium impact is medium impact of transition risk of carbon price, and then the green one is low impact. And then how does it impact? So if you take many obligors and put them in three buckets: high impact like manufacturing and so on, and then medium impact, yeah, it could be sort of maybe I don't know, car industry, or low impact other ones, or construction would be in high impact, and then low impact could be education and that type of thing. And then you say, how does the sector PD evolve under a scenario? And the scenario that was taken for this exercise, it was provided by the Central Bank of the UAE. So we see that it's sort of quite different, the evolution. And when you make loans to these, it will evolve a lot. And you need to know about this before making the loan. Firstly, the lending decision itself, and then the amount of interest rate that you're going to charge. So it's all very connected, and that's why it's so important, climate risk. One dangerous thing about climate risk is sometimes it's a bit slow in some countries, maybe not in Indonesia, but in some countries. So then people sort of don't see the direct impact. But there is recently a report from the Norwegian Sovereign Wealth Fund, which has sort of, people are talking a lot about that on LinkedIn. And that report says that many of the well-known providers of climate risk information have underestimated the risk. And that's a very big sort of thing, because some physical risk is much higher than what was some very established companies who provide climate data were talking about some 2% risk, and they say no, the actual risk is 27% damage to properties. Well, anyway, that obviously depends on regions and so on. So basically, climate risk can no longer be ignored, and that's a very important point, and that's why OJK is coming out. So this is a framework, and the basic thing now is that you need to implement that framework. But what we've shown you up till now is that the results of how we implemented exactly that framework. We did not do it for Indonesia, this particular one, because this has just come out, but some other regulators are more sort of have a lead in it, and they did this thing 4 years ago, 5 years ago. So now this is a bit more established, for example, in the UK. So we've done it, but it's very aligned. And then you need to calculate your capital adequacy and that type of thing. And then climate change, I think very soon we will sort of have to wrap up. There's lots we can talk about, but this was just to give you a flavor, but maybe I continue for a few minutes, but we'll still give some time for Q&A. I'm not going to go through all this thing about that climate change is real, but there's all these diagrams and so on, and figures you may have seen from NASA and so on, that carbon dioxide has never been so high and so on. And then basic thing is that the hottest year on record were the previous years. So it's no coincidence what we see here. Climate change is really here, and every year beats some record. So it's very serious. And all these gases that are contributing, so you need to reduce those emissions. And basically it's the CO2 and other GHG emissions that cause the mean temperature rise. The 1.5 degrees is impossible now to achieve. 2.5, some people said, yeah, 2.5. And then that causes heat waves, droughts, and so on. We're not going to go too much into it. There's a dictionary of climate risk, which are the chronic physical risk, which are long-term and acute physical risk, and transition climate risk, and it also has an impact on supply chain. So supply chain risk. I'm not going to also go through it. There's lots of data available, but we will run out of time here. Maybe mention a few things. For example, this is an actual example from TCFD, the Japan Airlines, how they are going to net zero. So this is what we see, this chart going down. That's their emissions. And it was still 2019 when this graph was made. And then the rest is projection. That's the result of scenario analysis. So you say, I'm here, how will I evolve in future? So then you have to do about it. So this is what you would do. And this is the total CO2 emissions. And you see it's going down. It's net zero 2050. Then I would say that this is taken from ABN AMRO's report, climate risk, physical risk, transition risk, environmental risk. This is the non-climate part of it. It impacts your credit risk to varying degrees, market risk in the trading book, market risk in the banking book, not much impact here. Liquidity risk, well, they've sort of, business risk, operational, non-financial risk. How does it impact? So you need to do this type of assessment. And this is a bit high level, but yeah, this is taken from their annual report. And then they have very detailed ones as well. It's like a heat map for different sectors that they are lending to. What is the sensitivity to transition risk and physical risk? And then there is a legend, a medium, high, and high sensitivity, moderately high, moderate, and so on. So this is the type of end result. So you need to do the result. And this was also related to the question that we will come to shortly on agriculture. So there's agriculture, forestry, fishing, and so on. You can use a bit of AI as well to help you. We also help our clients with AI and also have AI sort of modules. But then they have a climate heat map. So then you do the heat map of by sector, like this is for agriculture and how it would impact you. So then you can have detail. This is a sensitivity to physical risk. This is a sensitivity to transition risk. And that's the end result of your sort of work. This is again from ABN AMRO. This is from Barclays. I'm not going to go too much into detail, but this is the type of thing that you're going to report: total energy use, GHG emissions intensity. There are different measures and how you want to sort of go over time. Well, this is just for one time, the scope 3, but you need to also report how you are going to evolve over time. Maybe 2 more minutes quickly, and then conclude. The ESG related regulation, which includes climate at the very top level. This is to help you navigate it. It can be divided into sort of 4 buckets. Some people will say 2 buckets, but main one is the sustainability reporting, like CSRD, TCFD, ISSB, OJK, some elements of OJK. And then there is a sustainable finance reporting, which is what qualifies as sustainable finance and anti-greenwashing, as some people call it. And then there's the climate stress testing regulation. You have Bank of England, European Central Bank, OJK, Federal Reserve, CBUE, etc. Other banks have now come out, Oman, Jordan, many other countries, Hong Kong, China did it a bit before. And then you have climate scenarios. We've put it to 4th climate scenarios because we think it's sort of part of the regulation. But yeah, you can argue about it, whether it's part of regulation or not. But in some ways it is, because Bank of England publishes their own scenarios. They are derived from IPCC and so on. And then this is the European Central Bank diagram, which says that the annual GDP will change. The blue part here, the fan as they call it, the fan has this top part and the bottom part. So the GDP will vary in that region if there was no climate risk. But with climate risk, it varies in the red fan, and that is lower than the blue one. So climate risk has a negative impact on GDP, which means more defaults, for example. And then also on this, say the same thing. How does it? This is for the whole economy on the left-hand side. On the right-hand side is for your CET1 ratio. How does it impact? And you see that the CET1 ratio in different scenarios is lower than if there was no climate risk. And that's the whole point of this stress testing. So this diagram is a very good diagram taken from the European Central Bank guidance. Yeah, I'm not going to go too much into this, but maybe just mention that this is taken from TCFD. This diagram is copied from there, and it says the basic thing about climate risk and opportunities is that you project on your income statement, cash flow statement, and balance sheet the impact. So if there are losses, how does it translate on these statements? And that's what we showed you at the start, that you need to project those statements by scenario. And then you have your sustainable, this diagram shows that there's interlinkages between finance and sustainability, sorry, and that is what you need to capture. So if you're going to reduce your emissions, that will have financial consequences, will have capex, and that will impact your P&L and eventually balance sheet. I'm not going to go this you know very well, the 6 books of OJK, but yeah, we've gone through it and sort of these books, and they're very aligned to regulation as the chart showed. But very quickly, maybe mention the scenarios. You may have heard about these scenarios, SSP and so on. SSP 8.5 is the most adverse one. You can even have more adverse than that, but that's the common one, and so on. People use these scenarios. And then if you have seen these diagrams, these are NGFS diagrams, which shows the transition risk and physical risk, and then what are the different types of high-level scenarios. People wanted to do the net zero 2050 1.5 degrees above the mean temperature, but that's impossible to attain. It's too late. And then it gives details about it, and we copied this from OJK. So it's very aligned to what internationally is being done. And just to mention that these scenarios are useful, but what you really need is some detailed scenario before you can do your IFRS 9 projections. And ICAP. So here there's a typical scenario that we constructed for some work that we were doing in Denmark. The yellow part is macroeconomic, the green part is physical risk, and the pink part at the bottom is transition climate risk. So this is type of sort of scenario that you need to construct. I'm not going to go through this, then you can have your dashboards. But maybe the best is that I stop here and take some questions. So there is a lot that can be said, and we sort of, the whole point was to demystify a bit, give you some flavor of it, and obviously if people want, they could have one-to-ones, more detailed sessions. So I just stop here.
I think I would like to bring up some my thoughts, Nasir, and
Please.
perhaps I also represent. I think there are some rural banks. Rural bank is below regional banks in terms of asset and everything. So by looking at your webinars, definitely we do have the data. We do have the balance sheet, financial statement, cash flow, etc., etc. So you're also saying in the beginning that this climate risk also make an impact, right? So I think one of the questions raised by some of audience here. So as a smaller banks, I think the title is stress testing and also stress. I mean, like risk analysis, right? Scenario.
Yes. Yeah.
So as a smaller bank, how do we start with this climate risk, for example, integrating with the macroeconomics and also, let's say, our NPL? How do we start it? I think since this is a part of the education, what are the steps to start with? Thank you.
So that's a very good point. So yeah, I mean, in some ways one can do it in a very sophisticated way, etc., and so on. It's not really required for smaller institutions. So it's something quite simple that needs to be done. You need to take your obligors, the people that you've given loan to, and you need to put them in the right buckets and sectors and so on. And you can say, this is agriculture, this is manufacturing, this is financial services, this is education, and so on. Some sectors will not be impacted at all or very little impact. I mean, obviously, if it's a school and it's in flooding, then it will be education also. But generally, it will depend a lot on sectors. Then you will need to do some sort of a heat map at the start by which risks are important for these sectors. Is it flooding? Is it heat wave? Is it both of those? Is it hurricane? Is it wildfire? There are no wildfires, maybe. And then you say which transition risk? Is it the carbon tax? Are they operating internationally? Is there a change in regulation? And then you do that. And then you can say that how those companies will evolve over time. And do you want to give them more loan? Their PD will change. So you say, okay, I have already good IFRS 9 models. They are not climate enhanced, as people say. How can I bring in a climate? And you have to do slowly. In the beginning, you have to do it in a sort of slow way and then increase the sophistication. So for example, for mortgage loans in certain areas, you would say that you would need some sort of a flood probability by postcode. And then you would need a simple model that would say, this is how flood probability has changed in the last few years on different postcodes. And now this is how this increase in flood probability will impact my LGD. And that connection you need to make, because if you don't make that connection, you will never be able to capture climate risk. And that connection is called the transmission mechanism, like by Bank of England, which means that something gets transmitted. So that's the flood risk. And similarly, so you need to tweak the models. It doesn't mean that you have to do the full, but you need some data on flood probability, or not probability, on the flood aspects, and which you will convert to flood probability. So there is some data collection, there is some, but maybe the best thing I can say, advice would be to start with some sort of a proof of concept type of thing. Even if the bank is doing it themselves, they can use consultants, but they can do it themselves as well. But with some sort of, you can say, I start with the portfolio, I start with the agriculture portfolio, and I just do it for 100 obligors, and then you do, and then you would understand how to replicate it at a larger scale. But some data would be required, and some changing of models would be required, and some, before the changing of the model, some heat map would be required. Yeah.
Thank you, Nasir.
I think that addresses a bit the agriculture part of the question as well. But if people have other questions, please feel free. And this is a very big area, so I mean, in 45 minutes we can just give you a flavor of it, and hopefully you got that flavor. But we can talk for hours on this, and many. Yeah. And we've gone through the regulation. It looks very aligned to international regulation, and in that way, it's quite straightforward. Yes, if you are at the very beginning, it may seem very complex, but the whole point is to make it simple. Yeah. Any other questions or comments?
Arif, maybe you can check with the participants if they have any questions.
Ya, Bapak-bapak, Ibu sekalian, bisa bahasa Indonesia? Nanti saya bantu untuk ininya. Silakan. Atau mau di chat aja nggak apa-apa.
People can either raise their hands, we'll allow them to, or they can drop in their questions on the chat.
Yeah, I already told them, Pratik, Indonesian are shy.
Sure.
Okay.
I think they private message me one request, they'd like to learn about the material that shared by Nasir, and also they'd like to have some sort of one-on-one discussion with me, either on call, private discussion, et cetera, Pratik and Pak Nasir. Oh, there's a question
okay.
here.
Yeah, so there are two questions. I'll quickly try. Does ISSB consider that scenario-based analysis used in sustainability climate risk could have an impact, requiring all companies under its jurisdiction to disclose their strategies openly, thereby leaving little room for companies to maintain their... Yeah, look, I mean, one can argue this about a financial element as well. So the whole point is, firstly, ISSB took over TCFD, and TCFD was started by different people, but the two most important people was Mark Carney, the Canadian ex-bank governor of Bank of England, and Michael Bloomberg. So I mean, this is very market focused. So the whole point is to give good information to the market. So if someone wants to invest in your company, then they are going to read your disclosure, and that disclosure should give good insights into what the company is. Otherwise, they will not invest in it. So from that perspective, it's sort of the flip side of the competitive advantage. You can still have things which you sort of keep to yourself, but I mean, the goal is that if an investor is interested in your company, then they should have enough information from the disclosure. That's the whole point of TCFD. Yeah? So I think that question is that. The next question is, so far, how is the regulation related to carbon tax has been socialized? So if I interpret it correctly, socializing here means that how are people sort of talking about it, or in the sense that carbon tax transition risk is a big risk. And when Bank of England did their own climate stress test, they thought that it was this is the first bank to do it, first central bank to do it, and that was in 2021. And they said actually transition risk carbon tax has for that year had a bigger impact than physical risk. That may change over time, but so if people have if people have restrictions on their emissions and then they have to pay a tax that has a direct impact on P&L. So transition risk is quite important, and there are good Bank of England papers or graphs on their website that show that. But I'm not sure whether that was, I was not sure what the word socialize mean here, but maybe the person can explain.
I think socialize meaning to say is these things is something new, right? To the
Yeah.
people, especially in Indonesia. So I think some sort of awareness, that that's why we call socialization is something like awareness, how
Okay.
people aware of this, Nasir.
Okay. Arif, yeah, then in that case, I think this is that, I mean, for people whose bottom line will be hit by it, then obviously they would be very aware of it for the new carbon tax. But I think there is certainly, as I mentioned in one of the slides, there is an education element. You need to educate the board. You need to educate the people in the company, in the bank, that what this means, how does it manifest, what is the implication, how do you compare with other countries, and so on. So the socialization, I think, would have started. I don't know the details about Indonesia, but it is a very important part. Yeah. And then there is one more question: how to consider which scenario is more possible than the other, and which one that we can use? Very, very good question. If you can use scenario with a low likelihood, what's the point with the numbers? Should we consider scenario with the highest likelihood only? I would say like this, that for example, even the IFRS 9 without climate many people use 3 scenarios. So the goal of the scenario is to not choose one, but choose more than 1, 2, 3, 4, and it gives you a range. So you now know the range. So that is what they call the taming the uncertainty. So before that, you did not even know what is the range. So now you know the range. So the main point is the range. And then you can take some weighted average, which will depend on the probability. But I think that one should take quite adverse scenarios and also benign scenarios and so on. So it's a range of scenarios which will give you the real benefit of scenario analysis. And choosing one scenario may not be that useful. Yeah. So the answer would be: should we consider scenario with the highest likelihood only? I would say no. You should consider other scenario. It's a combination of likelihood and severity. So basically, you should. But what regulators and standards require is that you choose high severity scenario and also low severity scenario. They don't even talk about probability. But obviously, for your expected credit loss, there has to be probability in it. So, but the answer would be that, and this is the second question, so it should be no, that you should not choose only the highest likelihood. But the first question is how to consider scenarios with more. So what we recommend to our clients is that all these famous scenarios, NGFS, IPC, is really great scenarios. Those are the starting point. And as I showed, actually, that is specifically why I showed that slide, that you have to take that as a starting point and construct your own scenario, which is called the scenario expansion exercise. So in that scenario, you can have one scenario for the bank, or not one. We just said you should have more than one, but you can have, let's say, if you say, I'm going to have 3 scenarios, and then you would have to have 3 expanded scenarios for the bank. And those scenarios would be the one that you use, and it would be tailored to your bank and to your obligor thing. So that's how it would be. And sorry, if I can just quickly maybe just for this one just show that. So if you say that this would be the type of scenarios that people would say low demand and so on. This is from the OJK. So you can say, which one do I choose? Yeah, you have to select maybe below 2 Celsius is, yeah, a bit not possible now, but you will choose, but as a high level, but you will not be able to directly use it into your ECL or NPL calculation. For NPL calculation, you will need to construct a scenario like this. So with the macroeconomic part yellow and the physical part and then the transition part, and that's the scenario expansion. The end result of the scenario expansion, you start with this and you end with this. And then if you choose 3 scenarios, you will have 3 tables like this, and these 3 tables will go into the NPL calculation. Yeah, we do that calculation all the time. Yeah. So I think that is that one. Is there? No, I think that was the last question for now. Good questions, yeah.
Very good questions. Anything else, guys? Nanti saya akan kirimkan summary-nya dari yang apa dipaparkan oleh Pak Nasir. Saya rasa semuanya udah tahu ya. HP saya 0816 189 2624. Email saya arief.kusuma@aptivaa.com. Jadi bisa email saya, WA saya 24/7 online and real time. Ya.
Okay.
Yeah, I think we can conclude the session webinars, Pratik. I think some they private message me to have offline discussion on this as well.
Okay, yes. Hope you find it sort of instructive.
Any closing statement from you, Pak Nasir?
No, I just hope that people found it useful, that we try to sort of give a cross section of what is required, and they feel less confused and less afraid of climate risk. I think that was the goal, and maybe with the slides. But happy to have separate one-to-one conversations with people, and maybe Pratik wants to add one last point before we close. Pratik, anything from your side?
No, thank you so much, Nasir. So as a closing statement, I would only say that, the idea of having this webinar was to demystify the regulation, and we speak with banks across the globe. Nasir himself has been very active in the areas, specifically in the region Middle East and Europe. And what we have seen is that the initial worry of adding climate risk to the day-to-day operations, specifically coming into the regulatory aspects of reporting, be it for the IFRS 9 inclusion, for the scorecards and the rating models. And what we have seen is that there should be a place to start. You can start small with areas of bringing it into the reporting side of regulatory requirement, and then eventually even adding it into your sort of decision making operations for your credit risk areas. So there's only so much we can sort of say or do in a presentation of 45 minutes for a topic that is vast in its nature. But we are happy to sort of have a more detailed session on a specific area that you feel you are wanting to explore, or have some areas you feel needs enhancement, and then we'll be more than happy to sort of come in and work those areas out. We've had good references of working with geographies and economies that have done quite a bit of work in ESG and climate risk area, and then that has given us a unique placement to sort of avoid the mistakes they would have done while they started on this journey of climate risk. So sort of building from the experience of us also making mistakes, understanding the challenges that banks and financial institutions face when they embark on this journey. I think that brings us to a value add to the current operation and the sort of roadmap the banks would have when it comes to ESG journey. With that, I mean, I thank you everyone for joining us today. I'll also be in Jakarta next week. Pak Arif is always in Jakarta. So whenever you're required, you can reach out to any one of us, and we'll be more than happy to schedule a session more detailed with Nasir. Thank you again. I'll leave it to Arif to maybe close in. And before my apologies. Before we close, I believe most of you would be celebrating Eid al-Adha. So Eid al-Adha Mubarak to everyone from us at Aptivaa and at Cognext. And over to you, Karif. Thank you so much.
Terima kasih Pak Nasir dan Pak Pratik. Terima kasih Bapak-Bapak dan Ibu sekalian. Ya tadi Pratik sudah sampaikan bahwa beliau akan ada di Jakarta dari tanggal 9 sampai 13. Kalau saya anytime, jadi kita bisa diskusi yang lebih intens ya, lebih private, one on one gitu ya. Terima kasih atas waktunya dan partisipasi, dan mungkin kita akan ada webinar seri yang kedua dan saya akan kasih tahu ke Bapak-Bapak dan Ibu sekalian. Sekali lagi terima kasih. Terima kasih. Terima kasih. Thank you so much.
Guys,
Bye.
Terima kasih
Bye.
sama-sama.
bye.
Bye-bye.
Terima kasih.